Today I'm going to talk about what you should be looking out for when you buy T-bills. Now, don't get me wrong, T-bills are excellent. I love it. Alright, the latest T-bill gave 4.19% return. So it's a very good place for you to store savings in the short term and get very good interest rates. But still, there are some things you should take note of before buying T-bills. I'm going to start with the obvious, and if you don't already know, T-bills are not liquid. So you better make sure that the amount that you put aside for 6 months is something that you can set aside for 6 months and not touch, because unlike Singapore savings bond where you can actually withdraw any month and get your interest, T-bills do not have that option, and you will actually have to resell your T-bills if you urgently need the money. And take note that it is very difficult to sell because there might not be a secondary market that wants to buy your T-bill. Because if I wanted to sign up for T-bills, I just do it directly with the government. Why should I buy yours? Unless yours is a very attractive rates. And with the way interest rates have been increasing, you are likely not to be able to sell T-bills or sell it at a loss. And therefore, you should be prepared that the money you put in T-bills have to be set aside for the duration of the T-bill. So typically 6 or 12 months. So while 6 months is a relatively short period of time, do not put all of your emergency savings in T-bill. Remember, emergencies by their very nature are unpredictable and you're not sure how much you might need in such a scenario. So make sure you have your emergency savings settled before you buy T-bills. This video is brought to you by Moo, and you should definitely sign up using my link below because you can get free shares to kickstart your investment journey and also get no commission as well as no platform fee for a year if you trade on US stock market. And you can also get pretty low commissions if you trade on the SG stock market. Check out the latest promotion with my link below and score yourself some free shares and goodies. Every sign up goes directly to helping me create more content for this channel, and I thank you for signing up, and thanks to Mubu for sponsoring this video. Now, many people have realized because of the high rates that T-bills offer, they can actually use their CPF OA savings to invest in T-bills and therefore enjoy a higher interest rate for their CPF savings. Now, this is a legitimate strategy, but again, do take note that it's not as straightforward. Just because the T-bill interest rate is higher, that you should just plumb your CPF savings into it. When you use your CPF savings to buy a 6-month T-bill, you will expect to not get interest from your CPF for 6 months and then get the interest from your T-bills for that 6 months. But it's not so straightforward because of how CPF works. You can actually lose 7 or even 8 months of interest from your CPF account when you buy a 6-month T-bill. This is due to the way CPF calculates interest. The amounts you receive this month will only attract interest the next month, whereas withdrawals made this month will not attract interest within the month itself. To illustrate, now it's November, and if you use $10,000 of your CPF OA to invest in this month's T-bill, what happens is that $10,000 will not attract interest in the month of November because it has been used to buy the T-bill. And then your T-bill will mature in May, and the $10,000 will come back into your account in May. However, this $10,000 will also not attract interest in the month of May, and therefore you have actually lost 7 months of interest from your CPF rather than just 6 months. Of course, now that T-bill rates are high, this isn't that much of an issue. You should still use your CPF savings that are idling in your account, right, to put into T-bills to enjoy a higher interest rate. When T-bill rates start to come closer to CPF rates, you should start to calculate what is your break-even point, as well as whether or not the higher interest, if it's only a little bit, is worth your time and effort to use your CPF to invest in T-bills. The number to look out for is when T-bills come close to 3%, because now you have to consider the month of interest that you are losing, as well as some of the fees involved when you buy T-bills using your CPF OA savings. And therefore, once it starts to cross into the 3% territory, it is not so clear-cut that you should just use your CPF savings to go and buy T-bills. In fact, you may lose as much as 8 months of interest for some T-bills. Take for example this T-bill where the auction date is 27th of October and the issue date was 1st of November and the maturity is in May. A total of 8 months of interest will be lost from your CPF account, and therefore the extra interest you earn is not as great as you might think. So a few things you should take note of when it comes to this issue. Try to avoid T-bills whose auction dates and issue dates actually cross the end of the month. Number 2, you should try to buy 1-year T-bills where available, because that means you only lose 13 months of interest for 12 months rather than if you buy back-to-back 2 6-month T-bills, and that means you will lose 14 months of interest for the 12 months of investment. Okay, I realize that this point is not exactly true because if you buy your second 6-month
T-bill in the same month that your first T-bill matures, you actually only lose 13 months of interest. But yeah, just buy 1 year one if possible, because you will queue less at the bank.
And number 3, when T-bill rates start to fall to around 3%, you should start to realize that that's when you should calculate and see whether or not it's a good idea to continue investing your CPF savings into T-bills. One final issue about T-bills is that the rate is not known until the auction date, unlike SSB where you know the rate and then you decide whether or not to put your money in. So a lot of people are actually bidding non-competitively, which means they are taking the rates that are decided by the auction. But I think with interest rates creeping up, even in bank deposits, for example, OCBC 360, which is giving 4.65% if you can put $100,000 in and fulfill some conditions, you may actually want to do competitive bidding instead to make sure that you get a rate that you're okay with and does not pose too much opportunity cost. When you bid competitively, what happens is that you actually set an interest rate that you think you will be happy with. So let's say I have some money and I can get 4% per annum from my bank account, and I will therefore bid about 4.1% to see whether I can get a better rate with T-bills. And based on the last auction cutoff yield of 4.19%, I will have gotten my entire sum fully allocated at 4.19%. However, if the cutoff yield is actually 4.05%, for example, I actually do not get any allocated because my bid was higher than the cutoff yield. And that's fine, because now I have the money still in my bank and then I enjoy the bank interest rate of 4%. So the advantage of competitive bid is that you actually get the rate that you're happy with instead of just taking the price, because there might be situations where the rates are actually lower than expected and then you end up disappointed. Now that interest rates are high, I think most people will be very happy with what they get from the non-competitive bid. However, when interest rates start to come down and the rates are not as attractive, if you just take the yield as it is, you may end up in situations where you're not happy with the interest rates, but your money has already been taken out from your account to buy the T-bill. And this is particularly important for people who are using their CPF savings to invest. Let's say interest rates start to go down and now the rates are around 3%. If you don't set a floor interest rate that you'll be happy with, you might end up with an interest rate that actually doesn't earn you much more than your CPF savings, or even lower. Again, this is more relevant when interest rates go closer to CPF rates. Now note also that if non-competitive allocations start to cross 40% of the amount offered, there will actually be a prorated allocation, and that means that you might not get your entire subscription filled. So a little bit like SSB, there is a chance of oversubscription when it comes to non-competitive bid. And we have already seen non-competitive applications cross 39% in the October T-bill. So I think it's very likely for it to cross 40% and therefore be allocated on a prorated basis. Oversubscription, just like SSB. So you want to make sure that 100% of your amount you subscribe will be allocated to you. You should put in a competitive bid that is of a reasonable interest rate. So if you set it too high, you will get 0% allocated, but if you set it below the cutoff yield, you will get 100% of your application subscribed at the cutoff yield. Do note that there's a chance that you will hit the cutoff yield exactly on the nose and therefore only get a certain percentage of your subscribed amount allocated to you. And of course, when more people go the competitive route, you can also expect interest rate to be lower as more people try to outbid each other to get 100% allocation. Well, that's the nature of an auction. Now, if you like this video, do drop me a like and also subscribe to my Telegram group for more related content and great financial deals. Also, now that you know the things about T-bills you should be looking out for, go and look at all these issues about SSBs and how to overcome them in this video, and I'll see you in that video.